So you found a business doing about $1 million in revenue, $250,000 worth of selling discretionary earnings, selling for 2.5 times, maybe 3 times SDE. So far, so good. Except that there is one thing that a lot of people are not talking about that is coming up more and more the bigger the deal gets, and that is working capital. So I want to talk about it in today's video because it's not discussed enough. So I want to tell you three things that you're going to learn today in this video. What working capital actually is, why it matters in acquisitions, particularly as you get into the $2 to $3 million range, and how to protect yourself in negotiations because that could make or break the deal. So let's get into it. Hey everybody, welcome to my channel. I am your host, Leo Landaverde, business broker and commercial lender helping you buy and scale a profitable business. If you are a small business owner looking to expand, or a W-2 employee sick and tired of the rat race wanting to get out by buying a profitable business, you are in the right place. Please subscribe to my channel. Don't forget to hit the bell and you'll be notified every Thursday when new content comes out. Okay, so what is working capital? Well, working capital is, to put it simply, gas in the tank. So you buy a business. Now, the working capital is the delta between your current assets and your current liabilities. So it is the difference, it's what makes the business run. It's the cash that is going to make you make the payroll for the first month. The actual definition is current assets minus current liabilities. What are current assets? Current assets is cash, AR, prepaid expenses, and anything that you can turn into cash within the first year or within 12 months. And the current liabilities is anything that is due up to 12 months, which is your payroll liabilities, sales tax, and then some, your AP. It's also part of your current liabilities. So you take your current assets minus current liabilities, you're going to have working capital. Working capital is expressed at a point in time. Now, what we really want to know with working capital is how much cash does it take to run a business in the first 30, 45, or 30, 60, and 90 days when you buy a business. Now, in most cases, when you're buying a business, most of you will be doing an asset purchase, which means that you're going to cherry pick the assets of an existing legal entity and drop them into your new co, which is called the new legal entity, that you're buying those assets, your customer lists, the intellectual property, furniture, fixtures, and equipment that you're going to get to. Anything that you need to run the business, the employees are assets, the paperwork, the SOPs, the website, and anything that actually you need to turn a sale, that's what comes with it. But normally, the cash in the bank, the accounts receivable, and a lot of the prepaid expenses, all those stayed with the seller. So if the seller has $1.5 million sitting in the bank account and you buy the business, doesn't mean you're going to get any of that. So that is often a point of contention. So there's all these things that you need to understand, and it's very common amongst lower private equity, any deal that is 1 to 20 million to have to have working capital. Now, because working capital, somebody has to come up with. It's either going to come from you, the buyer, right? Or it's going to come from the seller, or it's going to come from the bank. Oh, and the bank will love to give it to you, right? They know you need it, and they'll be willing to give it to you because it's more money that they're put out to work that they're going to collect interest on. But the best way to do it is when you have the seller come up with it. And if you are going to go with, most of our students actually going to go with an SBA loan, the SBA lender is going to assess to make sure that if you don't get it from the seller, and if you don't want it from the bank, that you're going to have 10% equity injection, you're going to have 10% post-closing liquidity, you're going to have 10% of working capital. As simple as that. Now, what is getting very, very murky, if you're actually throwing every dollar you have into the equity injection, you won't have the working capital. So why is it a hidden price? Working capital isn't always included in the purchase price. Now, it depends who I'm representing. So if I'm representing the seller, I don't want to give it. If I'm representing the buyer, I definitely need it or want it and will ask for it in the LOI. Now, it's not something that you can ask inside of an asset purchase agreement because the deal points are negotiated inside of a letter of intent, which we call the LOI, which we have templates. Now, for those of you who are watching this video and are members of our community, you know what I'm talking about. If you want to know more about our community, we have actually over 154 members. We closed over $665 million worth of business. We are closing probably another 5 to 10 businesses before the end of the year. And we are constantly talking about that. We're now talking more and more about working capital. It is the default of the seller is not to include it. And that number can be as little as $50,000 on a small deal. It can be as much as $500,000. Let me illustrate. I have a deal. I have several deals in the market. I just received an offer on a deal on one of usually my deals are anywhere from $2 to $10 million aggregate purchase value. So they are the domain of the private equity groups, the family offices, and high net worth individuals. Now, we just do a pre-flight calculation before we accepted the offer because the buyer, who is a private equity group, wanted working capital. We know that number is $500,000, but whoever speaks first loses. We don't want to disclose what that is. So anyway, it's not always included. It as a negotiated point. Sellers often assume that they'll retain it. They don't want to give it to you. Think about it. If they're selling the business for $2 million and they have $1 million in the bank, $2 million plus $1 million, they actually walk away with $3 million, right? So it's remember, you're cherry picking. You're gonna take some things from their balance sheet. You're gonna put it into your balance sheet, but the cash stays with them. And the surprise most buyers find says that if you didn't negotiate it inside of an LOI before it was fully executed, you're gonna have the hardest time, and if it's gonna be even impossible to get it on the negotiating state post due diligence inside of the asset purchase agreement, because the asset purchase agreement is nothing but a extended version of your LOI. So things like the purchase price and terms, that's negotiated in the LOI. The exclusivity period, how long we're going to do due diligence, whether working capital is involved, whether there's going to be retainage, whether there's going to be money set aside in escrow if you're buying the stock, to be offset against any liabilities when you're buying the stock, and other triggers and things like that, and the non-competes, and how long when the seller is going to stick around. All of those things get negotiated in the LOI. Are you stuck in trying to figure out how to buy a business? You want to know what comes next or before? Should we be reaching out to lenders now or later when you have an LOI under contract? Do you do an LOI before you analyze the deal? When do you do the business valuation? How do you know how much business you can even buy? What is working capital? Do you even care? I'm sure you have questions. We want to help you with the answers. Please reach out to us, book a call, a complimentary call with a member of my team. Just drop me a comment below here, or just send me an email. Email address is up here. So the business deal points are negotiated in the LOI on most of the bigger deals. Now, smaller deals, you can probably have a purchase agreement. If it is less than $1 million purchase value, a lot of brokers are just, hey, look, if you're really serious, here's the purchase agreement. Especially hot businesses nowadays, they skip the LOI, go straight into the purchase agreement. Anyway, how does that affect the deal structure? So, typical scenarios on SBA deals is, this is what SBA lender will say, I need 10% equity injection from you. If the deal is strong, it has great sound cash flow and good debt service coverage ratio, 1.5 to 1 or even bigger, they're probably not going to have the seller carry anything. They're going to give you 90% loan to value. You take 10%. And if the cash flow is strong, they're going to say, we're going to give you an additional sum of money, $100,000, $200,000, $300,000 in addition as either a working capital line of credit, or they're going to give you an additional fund so you can have money to run the business for the first 2 months, because if you are creating invoices, you're not going to be able to collect on those invoices until 30, 45 days later, so you're going to need money to run the business. That is working capital. But once you're running the business for a few months, the working capital is generated by the business itself. So banks look at working capital as a runway. Think of your business as a small plane, or maybe a smaller jet, right? And they need to know that you have enough gas in the tank to take off. Whether that is 30, 45, 60, 90 days, they need to make sure you have enough gas to take off. Once you're mid-flight and the business is self-sustained and then you won't need working capital anymore, then the purpose is achieved. So It is sort of the default and is go-to embedded language in most of the private equity group deals that I do, the PEG deals or the family offices, that they actually have embedded language for working capital, which inside of our group I teach it. We actually compete in many deals and have won successfully against private equity groups and family offices. So, how you protect yourself in negotiations. So you're going to ask for a normalized level of working capital. Here's a pro tip. Don't determine what the working capital is at the LOI stage because you don't know what it is. You haven't looked under the hood. You haven't done due diligence. And in order for you to really calculate working capital, you need to go trailing 12 months or trailing 24 months, even better. Working capital is a calculation in time. So if you're calculating for the year, that doesn't mean that you're going to take that number divided by 12 and it's going to give you an average. It doesn't work that way. Working capital kind of depends on the seasonality of the business and many other factors, depending on the industry and how it behaves, etc. So you need to go back 24 months and then figure out what the monthly is per. You need P&Ls and particularly balance sheets by month, trailing 24 months. So you need to ask for a normalized level, which means what does it look like as you average? The longer the amount of months or the longer the term, the more you're going to normalize. So if 1 month is 100 and the other one is 200, the one is 300, then it's 200, 200, 200. It probably is $200,000 a month. The question is, how much of that do you want? And that is a negotiated point. Some people want 2 months, you're going to get 30 days. You want 90 days, you may get 45. You may not get anything at all. Now, if the business is faltering, and then there are other things that come into play in addition to working capital. Inside of the diligence, and when the bank is doing their own due diligence, they may realize the business is not doing as good as it should, and they may ask the seller to carry some, whether it's 5, 10, 15%. There's just a lot of moving parts to due diligence. It's not as easy as it is evaluating real estate. So, you're going to ask for normalized working capital, ideally 2 months. You're going to use a due diligence expert to assess your working capital needs. This is not something I want you to do on your own. It is far too complex to calculate. You need somebody who is a financial analyst like me, who is a broker, seasoned in calculating these numbers, because you need to be able to defend these numbers if you're going to get them negotiated into the deal as a buyer. So you're going to negotiate that ahead into the LOI, ahead of the APA, and you're going to watch out for inventory buybacks and all those retentions. And if you're doing in business in the trades, if you're buying a electrical contractor, HVAC, plumbing, and they have large jobs that go over several months, you're probably going to have work in progress, which means you're going to have WIP reports that you have to deal with, which play into the role of working capital. Because when you're doing trade work and there's a big job, $1 million job that goes over 6 months, well, then you're going to have progress billing, right? So if you're under billing, that is an asset. If you're over billing, that's a liability, and that plays into the working capital. Here's some situations. So the businesses that have the most need for working capital are the seasonal swings types businesses. For instance, a business that does paving or snow removal, and then in the winter, and then what do they do in the summer? So you need enough working capital to last the dry months. Service businesses versus inventory heavy businesses. Inventory heavy businesses are going to have more working capital needs. Manufacturing is going to have higher working capital needs. Anything that has cost of goods sold. So if you have revenue minus the cost to generate that sale, what we call cost of goods sold, that leads to the gross profit, but that plays into working capital. So there are ways that you can identify when a seller is manipulating the working capital. But if you're working with a seasoned group of advisors like me, it's not going to be an issue. So just to recap, working capital is no longer an option. You have to play the game. You have to elevate yourself, and you have to make it a negotiating point inside your deal. So for those of you watching, if you want to negotiate a deal, you're going to work. The best deals have working capital negotiated into it. So if you want to know more about working with us, we actually have a deal that is going to be advertised here, which we can access to 15 deals that we have reviewed, and to give you real class examples, and subscribe for more actionable M&A insights. Thank you so much for watching. For a limited time, we're giving away our Deal Analyzer 2.0, which has been floating around and being downloaded at least 3,000 times now currently use, and we have a souped up version inside of our paid mastermind. But what you have is enough with 50 formulas to calculate the debt service coverage ratio, the pre and post debt service cash flow, and many more things. In addition to that, I'm giving away our business buyers checklist. It's a 6-page document which really works like a punch list as you go through each item, preparing a deal to close. I'm sure it's going to help you. Download it. It is my gift to you.